David here with Best Consulting Specialist. This is the lesson on contribution margin. A common mistake is for executives to mistake contribution and gross margin for being the same thing. While similar, there's a distinct difference. Contribution margin shows the gross profitability of an individual product or group of products. Gross margin shows total profitability on all product sales. Another difference is contribution margin shows the earnings available from a product or a group of products available to pay for the fixed expenses and to generate a profit. Gross margin shows the total earnings available from all sales to pay for fixed expenses and to generate a profit. Contribution margin then is calculated by taking the product's price minus the product's variable cost per unit, while profit margin is calculated by taking the total sales minus the cost of goods sold. Three common uses of contribution margin are, first, to compare the profit each product is contributing to the company bottom line. This can help in determining where to focus cost cutting or which products to try and sell more of. A second use would be to determine a sales mix. And the third is for a break-even analysis for a given product. Let's look at an example on each one of these. Let's look at a comparison of three different products, A, B, and C. Product A has sales of $10,000 and a variable cost of $6,000. Its contribution margin then is $4,000. We calculated that by sales minus variable cost, or $10,000 minus $6,000. Just as importantly though, is the amount per unit dollar that we have left over to cover our fixed expenses and to contribute to the profit. We find that by calculating the contribution margin percentage. Contribution margin percent is just the product contribution margin divided by the product sales. The contribution margin percent for this product A is then 40%. That means that 40 cents of every dollar in sales is left over to cover fixed expenses and to add to the company profitability. So now let's move on now and calculate the contribution margin and contribution margin percent for products B and C. Filling in our table for the other two products shows us that while product C has the highest sales and contribution margin, product B actually provides the most amount of money per unit dollar to go towards fixed expenses and profits. We can use this to look at how to reduce our variable cost of products A and C or to increase sales of product B. Now let's turn our attention to sales mix. Here's the scenario. A customer can't decide whether to buy one of the larger pots, which is product C, or one of the smaller pots, which is product A, and one of the medium pots, which will be product B. Which way do you steer them to maximize your profit? Well, to be honest, to answer this question, we need one more piece of information. That piece of information is, what is the selling price per unit? So we added the unit selling price for each of the products to the table. Product A is $2, the selling price of product B is $3, and the price per unit of product C is $5. With this, we now calculate the contribution margin per unit, which is the selling price times the contribution margin percent. This makes the contribution margin per unit A at 80 cents, for product B $1.25, and for product C $1.84. So now we're able to answer our sales mix question. If the customer says, I only have space for one pot, then we're going to push for product C. This is going to maximize total contribution margin per unit to sell at $1.84. But what if the customer turns around and says, well, you know what? I could go for either one. Then you want to push for product A and product B purchase because the total contribution margin would be $2.05. To help solidify how to do a break-even analysis, let's look at an example. We're going to look at two different methods. The first would be a graphical, and the second will be from a spreadsheet. The graphical analysis is relatively simple. You plot the revenue and the expenses on a graph, and you look for the intercept of the two. The x-axis has our units, and the y-axis has the dollars. The second method is to calculate the break-even point by charting your revenue and your expenses. Let's start by finding the fixed cost. From our chart, the fixed cost is determined when we produce 0 units. At this point, we see our total expenses are still $45,000. That's our fixed cost. The second step is to determine the variable costs. Recall, variable costs are materials plus labor plus overhead. In this case, on our chart, we have $5,000 per 100 units as our variable cost. That equates to $50 per unit. Step 3 is to determine the contribution margin, which is equal to the product price per unit minus the total variable cost per unit. The product price from our chart is $20,000 per 100 units. That equates to $200 per unit. Therefore, the contribution margin is equal to $200 per unit minus $50 per unit, which is equal to $150 per unit. Step 4 is to calculate the break-even units, which is equal to the fixed cost, which was $45,000, divided by the contribution margin, which we just calculated as $150 per unit. Therefore, the break-even units are $45,000 divided by $150 per unit, which is equal to 300 units. Notice that that's the same intercept that we found in the graph of the revenue and the expenses. Our last step is to calculate the break-even dollars. This is as simple as taking the break-even units and multiplying it back by the price per unit. In our case, the break-even dollars are 300 units times $200 per unit, which is $60,000. Again, from our graph that we started with under method number 1, that's the intercept point of the revenue and expenses on that graph. Some follow-up lessons here would be break-even analysis, life cycle cost analysis, cost-based and accrual-based accounting, or our series on creating a budget. If you enjoyed this lesson, like us on Facebook, subscribe to our YouTube channel, and visit our website.